Hello friends, today I'm going to be talking about one of the important participants in the financial market, that is market maker. Okay, so today we are going to be discussing who is a market maker, how does a market maker makes money in the market, then what all impact he has on the liquidity of the market, and finally what is the advantage or disadvantage that he brings on table as a market maker in the business. Okay, so with this, let us start with this concept. So I'll give you a brief about an introduction. So suppose if you wish to sell out a house, which is an asset, which is a real asset in the market, you will have to wait for a certain amount of time before you actually go and find a buyer, and then you negotiate a deal, and then the house is actually sold. Okay, for a real asset, it takes some amount of time for you to find the buyer and to complete the entire transaction. But then how come a security, which is a financial asset, is sold so quickly? Okay, and why am I referring to real estate over here? Is that because that financial asset and or a real asset is generally illiquid. Okay, so an illiquid asset takes a time to get sold in the market, but an illiquid security, okay, can be executed very fast. What is the reason behind it? Okay, one of the reason behind it is having a market maker as a participant in the system. So let's talk about who exactly is a market maker. So suppose there is an investor who wish to buy a security, okay, and there is one more investor who wish to sell a security, but that security is primarily very illiquid. That means not many people actually go and do a trade. So there is not necessary that a buyer or seller will ideally be able to match on a particular trade. So in that scenario, market maker comes in between, okay, and he basically tries to take an opposite position in front of the buyer. That means in front of a buyer he becomes a seller, and in front of a seller he becomes a buyer. Okay, so what does a market maker is doing? Market maker is trying to create a market or trying to create liquidity in a particular asset by taking an opposite position as the investor comes in. So if an investor is coming from the perspective of buying, the market maker will become a seller, and if the investor is coming from the perspective of selling, the market maker will become a buyer. Okay, so that is the basic function of a market maker. Okay, and who all can be a market maker? So market maker generally is appointed by a stock exchange. So when we're talking about an exchange related system, you'll already have a market maker appointed by the regulator or appointed by the exchange itself, who basically takes two-way positions. Okay, and he basically quotes both the rates. That means whenever somebody comes to buy an asset, so he will be ready to sell that asset. He will give a selling side quote, and whenever somebody is coming to sell the asset, he will buy the asset by giving a buy side quote. Okay, so he's ready to take both the position. He's ready to take buy side, he's ready to take sell side throughout the trading day for a particular security, and thereby he's been able to maintain the liquidity and ease of trading for the other participants in the system. Okay, now whenever this is required, this is generally required for an asset which is generally illiquid. If already an asset is highly traded or highly liquid, then this kind of system will not be required because the market itself is very efficient. But if suppose there is an asset which is illiquid, there is not much trading happening in that, then you need a market maker to provide liquidity to that asset so that the trading becomes very easy. Okay, so that is another reason, and that is the reason you have majority of the large banks or large corporates or companies, brokerage firms, playing a role of market maker in the system. So you have an example of IDBI Capital, Canary Stockbroking, or Quantum Global working as a market maker in the system, in Indian ecosystem. Okay, and how do a market maker actually makes money? Okay, so market maker is ready to give both buy side and sell side. Okay, so let me give you an example. Suppose a market maker for a particular security is giving a buy side quote of $10. Similarly, he is giving a sell side quote of 10.05. What does this mean? That means that market maker is willing to buy that asset from you at $10, but if you need that asset from market maker, then market maker will sell the same asset to you at 10.05. Okay, so let's look at the first aspect, which is $10. That is a bid price. That means he is ready to buy the asset from you at $10. Okay, so that is the rate that he will basically give to somebody who is selling, and that's where your market maker becomes a buyer. Okay, so he is agreeing to buy a security at $10. Similarly, let us go to the next part, which is $10.05. That is the ask rate. What happens in that case? So this is the rate that goes to somebody who is planning to buy. So market maker becomes a seller for that security in that transaction. You can realize that there is a difference between them, that is $10 and $10.05. That difference is the spread that the market maker is actually making in the entire transaction. Okay, this spread is also called as bid ask spread. Okay, and what is the impact that the market maker has on the liquidity of the market of that security? Okay, so generally what happens, if there is a market maker available, he makes sure that the volumes of trade can be conducted on a security, because if he is not there, then you will not be able to conduct a trade of a huge volume. Okay, because there will be no other counterparty available, and hence when he comes down as a market maker, he provides or he facilitates for a volumes of trades to be conducted in that particular securities. Then he makes sure that the transaction can be safe and secure and can be fastly conducted in the market. Okay, so market maker provides that flexibility or that facility to the market. And finally, market maker gives a signal regarding the risk of the security. If suppose there is already a security available in the market, and that security is there's no market player in that security, then that means the market maker is assuming a high risk in that security, and that is the reason he's not able to enter, or he's not entering into that security because of the illiquidity issue. Okay, so market maker always gives you a signal about the risk of a security by the way of his transaction ability. That means the way he gives bid ask rate. Okay, so if suppose as per the example, we saw that the bid ask spread was $0.05 because the bid rate was $10 and the spread ask rate was 10.05. Okay, so if there is more illiquidity or if there is high risk in that particular security, then the bid ask spread will increase. Okay, why the bid ask spread should increase? Because the market maker wants to get compensated for the risk he is taking in that security. So bid ask spread is also a good signal of the risk of the security, which is shown by the market maker. Then what are the advantage of market making for a company? It basically helps them to analyze a security and speak about the company's true risk or nature. Okay, market maker generally also provides a constant source of liquidity for a security, and he helps to identify the true price of the script, or that is the valuation of that company. So when we are referring to script, that essentially means the stock. Okay, so that is the advantage from the company side. What is the advantage from the investor's perspective? So market maker provides a guarantee that the trade will be conducted with an easy, fast and secure manner. It also gives a very stiff competition among market makers, so that it creates a price efficiency. So if there are 4-5 market makers for a particular security, then an investor should ideally go to a market maker which is giving a very low bid ask spread or the low price for that transaction. Okay, so that from that perspective, it creates a lot of market efficiency among market maker, that will give you a better price as an investor. Finally, it helps you to pass on the relevant information regarding the company, like I said, related to the risk or related to the price or the valuation of the security, right? So what all things we covered today? We talked about who is a market maker. We also talked about what is the how does a market maker actually makes money, and what are the benefits of having a market maker in the business. How does a market maker actually impacts the liquidity of the market, and what are the advantage of a market making activity to the company who is doing it and to the investor who is also a participant in the market. Thank you.